Two stocks trading at a massive discount with significant upside that I am looking to buy. We're going to run through them both very briefly today. We're going to take a look at their historical performance, both of these companies at 52-week lows. We're going to very quickly look at their income statement, see whether or not their top line and bottom line have been moving in the right direction. And we will run through our financial metrics to see how strong these companies are, even though they are at their 52-week lows. And we will run them through our valuation model, getting to our intrinsic value as well as the acceptable buy price, given that investor margin of safety, as well as seeing Wall Street's forecasts over the next 12 months. Now, the first one should come as no surprise. We did recently do a very deep dive into LVMH. Now, over the last year, this is down 16%. It is pretty much right there towards its 52-week lows. We can see a trailing 12-month yield of just under 2% and a PE sitting around 20. Now, if this is one you have been holding over the last 10 years, well, you would be up around 309%. Now, it doesn't include those dividends reinvested, and we can see it touching just below $1,000. In fact, $1,000 at its 52-week high and all-time income statement. We're going to see whether or not it has been growing. Now, what we like to see over the last 5 years, 3 to 7% growth at a minimum. December 2018, 54 billion reported on the top line. December 22, 85 billion, with the trailing 12 months showing us signs that 2023 is expected to be 92 billion. Very, very nice to see. So it will have increased over the last 6 years very, very strongly. Now, on a more granular level, what we can point out, 2018 to 2019, we see the growth. 2020, that COVID year, no real surprise, we see a drop to the top line, but it then rebounds very nicely and continues to grow, even expected into 2023. Now, when we compare that to the bottom line, the net income, does it follow suit? Well, 7.3 billion net income in December 2018, 15.1 billion in 22, expected 17.5. Absolutely astronomical, very strong, more than double the bottom line over the last 6 years expected. But we do see it follow suit to the bottom line, 7.3 billion, and then we see an increase and then a decrease similar to that COVID year on the top line before rebounding very strongly. So LVMH, very strong in my opinion, top line and bottom line over the last 6 years. Now, in terms of looking at some of their metrics very quickly, 360 billion market cap. We're talking about a mega cap company. Dividend growth, 20% over the last full year. Very, very strong. Well above the minimum 4% we advocate on the channel. Double digits on average over the last 5 and 20 years. Absolutely strong in my opinion. Now, free cash flow, always look at that. Ignore earnings. It is susceptible to manipulation by management through accounting, and we do a ton of examples throughout the channel explaining why. Below 60% is my personal preference, so we can continue to see those double-digit increases. 2023 expected 59%. Now, it is one of the highest payout ratios over the last 10 years, but still, in my opinion, we should be expecting strong double-digit increase in 2024. Free cash flow per share, well, $6 to $25. Very strong growth over the last 10 years. In fact, we see more than 4 times growth over the period. But do note, there are some years of stable growth. There are some years of very strong growth. And do note, from 2021, it is expected to drop down, not just into 2022, but 2023 as well. So something just to consider. Sales growth, what more could you ask for? We want 3 to 7%. Well, over the last 3 years, double-digit growth. We see that COVID drop negative 17%, but even before then, we see some strong double digits increase to the top line year on year. And numerically, it can be shown nearly 3 times growth over the period, 29 billion in 2013, 85 expected in 2023. On top of that, shares outstanding. We love it as investors when companies do share buybacks. LVMH, though, we do pretty much see it flat, although they have bought back around 2 million worth of shares. ROIC, I won't personally touch many companies, if any, that don't have a minimum 10% consistently. This is because it gives me faith that management are able to effectively allocate their capital. So nice to see the last 2 years coming in at 21%. Margins, very strong. In fact, growing from the last 10 years, sitting at the high 20s over the last 3 years for the operating margin. Free cash flow margin, while it did peak in 2021, it has come down to 12% in 2023, but it is still something I can live with. At the minimum I would be looking for here is 7%, nothing lower. And the net debt to EBITDA, remember, earnings before interest, tax, depreciation, amortization shows us two things. Firstly, the dividend safety, and then secondly, the balance sheet strength. 1.57 years for LVMH to pay off all of their debt net of cash on hand, 1.62 in 2023. So no real worries there in my opinion, neither for the dividend or for that balance sheet strength. So let's jump into LVMH's stock analysis. As always, if you do enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel for the deep dives, we do run through every single one of these models. In particular for LVMH, if you do want to check that out, we in fact did a deep dive around 2 weeks ago. So we can see now the intrinsic value for today's episode is coming at $956. Now the current price sits at around $727. Margin of safety that we typically use, 10%, and we use that if we believe it has a wide moat, strong financial metrics, good forward-looking data. For LVMH, it is even more than 10%. We can see at 15% a buy up to 813, 20% up to 765, and at 25% pretty much not too far off the current trading price. So for LVMH, we see around a 25 or in fact a 20 to 25% margin of safety. In terms of Wall Street and what they forecast over the next 12 months, well, they see a price target of around $910 with around 25% upside. Let me know if this is one you are also adding to your portfolio. The second stock, which is incredibly undervalued with significant upside, we have Kering SA, down 33% over the last year, right at its 52-week close, with a trailing 12-month yield of 4% and a PE of 12.5. Now, if you've had this over the last 10 years, you would be up 105%, but do bear in mind its all-time highs were seen around 3 years ago at $946. In terms of their revenues, well, what we like to see, remember 3 to 7%, well, it has gone from around 15.7 billion in 2018 to 22 billion in 2022. 2023 expected a small uplift to the previous year at 22.4 billion. So again, it is increasing year on year. What's interesting to note, it does follow in that way of LVMH, where we see 2018 an increase to 19, then a dip in that COVID year before rebounding quite sharply and again increasing over the period. So it is moving in the right direction other than that COVID justification drop. Bottom line net income, what story? Well, slightly different to LVMH. 4.3 billion reported in 2018, 3.9 in 2022, and a drop expected in 2023. So we can in actual fact see their bottom line doesn't correlate to their top line. A drop into 2019 before a small increase in 2020, a nice increase in 2021 and 2022 before a small drop expected. So it's just something to bear in mind with Kering. Their bottom line isn't as consistent as their top line. Now, in terms of their market cap, well, 47 billion, a large cap company. When we look at their dividend growth, very similar to LVMH, double-digit increase last full year, last 5 years, and 9% on average over the last 20 years. Free cash flow payout, well, what we can see here, 64% expected in 2023, and pretty much since 2016, it has been consistently around 50 to 60%, so not that bad in my opinion, especially given they have continually been giving those strong double-digit increases. Free cash flow per share, fairly similar in fact to LVMH, $4.56 in 2013, $26 in 2022, although it is expected to drop sharply in 2023, hence why we do see a lot of that share price drop at the beginning of the episode. Sales growth slightly different to LVMH. In fact, we see 3 years of negative growth. We do have that justified COVID drop. 2021, 2022, nice double-digit growth. 2023 coming in at 5%, which is still between that minimum 3 to 7% we do target on the channel. Total sales then, they have more than doubled from around 10 billion to 21 billion expected in 2023. Shares outstanding, they've also done share buybacks, but very trivial. They've bought back around 3 million shares. Nothing really to note, and pretty similar in fact with LVMH. Now, return on invested capital, pretty strong, I would say, over the last 6 to 7 years. 2023, again, coming in at 19%. So I do like that consistency over the last 3 years of around 20%. Operating margin, very strong. It has been increasing. Again, there are very similar trends with LVMH. 27% over the last 2 years. Again, we do note that free cash flow margin dropped 9% in 2023, something to keep an eye on given how strong it had been from 2020 to 2022. Net debt to EBITDA 1.95 in 2022. It is expected to increase in 2023, so something just to keep an eye on. We really want to see a maximum of 3, which in fact they had gone over in 2013 to 2016. So let's jump into the valuation, but before we do, just to let you know that we have released a free weekly newsletter. The one that did recently drop on Sunday discussing the 7 golden dividend metrics. We talk about how we screen for undervalued stocks. Next week we will be doing a deep dive on an undervalued company. If you want to check that out, it's a free link below. Join the newsletter and you will go through all of those metrics and beyond. So let's get into the valuation of Kering SA stock. Now the intrinsic value for today's episode is coming to $595. Margin of safety then, let's start off with that 10% minimum, and we can see it is a buy up to $535. 15% still a buy, and we keep working our way until we get near the current trading price. And we can see with a 35% margin of safety, it is still a buy, not there yet at 40%. So it is between currently a 35 to 40% margin of safety, depending on how much it does drop when the market opens tomorrow. In terms of what Wall Street are forecasting for Kering, well, they see around 41% upside, a price target of $545. So they are very bullish on Kering as well as LVMH, although Wall Street do prefer this stock when you do put them both against each other. Now, one thing that we can do is take a look at both of these stocks side by side. And over the last year, we can see both have been hit very hard, although Kering is down significantly more at 32%. This is their total return, so includes those dividends reinvested. When we look at the 5-year, in actual fact, LVMH has been very strong, up 171%. Whereas Kering is down -7%. Although I do always say, do bear in mind, past performance is never an indicator for the future. And one final thing that I will say with LVMH that we did go through in our deep dive is the CEO has been buying back a significant amount of shares. We're talking in the millions. I think it was around 30 million euros worth. This is a very bullish signal, as we always say on the channel. Insider buying, management only really buy if they believe the share price will go up. Insider selling is for many different reasons. So as always though, just to point out, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, do click on that pinned comment below. And if you've enjoyed today's episode, smash that like button, hit the subscribe and bell button, and as always, we will catch you on the next one.